Again, welcome everybody to today's workshop. My name is Jason Hamilton, the founder of this group and the founder of Keep It Simple Financial Planning. So what we try to do every Sunday, and I missed last Sunday because I was busy with some family stuff, we try to come every Sunday and bring you a workshop that's going to help you just get a little bit better, if not a lot better, at planning for retirement and making sure you're getting to your stage of financial independence in the most efficient way possible. So that's really what the goal of a lot of these things are, is to make you more confident, get you on a better path, maybe help you recognize some things that you may not be thinking about to put you in a better spot so that you're in a good spot long term. To be honest, there's just so many little details when it comes to proper financial planning that there's just no way to do it all in one particular 30 or 45-minute workshop. So every week we bring things for you to build upon your knowledge. And then also you can find in the guide section a lot more videos there, all the past workshops. And then in the file section, there's a lot of downloads as well that you can get some free downloads there as well. So we try to do our best to bring you everything, but keep in mind, when you're putting together a full comprehensive retirement plan, you do definitely want to work with a professional, because there are the little things that you miss, and those little things can turn into big things when you're looking at a 30-year time frame. So on that note, what we're going to talk about today is talk about, for those of you that can save more money. I get a lot of questions about, where should I put my money? And what I've seen lately is a far majority people have about 100%, if not 90+% of their savings in a 401k or a pre-tax retirement account. So when it comes to retirement stage, ideally, we want to have what's called tax diversification. So that's a little bit different than what you might have heard of before of another term called asset diversification. So you might have heard of, the fact that you want to have stocks and bonds, and you want to have some international and some U.S. stocks, probably, some different sort of mutual funds or ETFs. But you may not have heard of tax diversification, where you might want to have different types of accounts that you can draw from, so that you're not having to take everything out of a pre-tax account, which means that's, those distributions are 100% taxable. So if you're in the stage of saving still, and we have a little bit of time, I think you're really going to enjoy this workshop, because I'm going to walk you through a workflow and some different ways to think about saving to hopefully help you set up for a more prosperous and help you keep more of that money from the government, as it seems like taxes are going nowhere but up in the future here with all this money we're printing. I want to help you keep the most of that money possible. So let's jump into our workshop today and talk about that. And if you have any questions, please leave them in the comments. And whoever's saying hello from Philly, hello there, hello back. It's great to have you here. Let's pull this up, and we're going to jump right into our workshop. Okay, so today's workshop is titled, I Can Save More. Where should I put my savings? Okay, so before we jump in, as always, I have to let you know that this is for educational purposes. This is not meant to be any sort of specific financial advice, legal advice, tax advice, but hopefully it is good and comprehensive, and you can learn a lot today. Okay, so where we have to start, right, is with the basics, because some people have the basics in order, but there's definitely people that don't. So I want to make sure you have all the basics in order. So what we're going to start with is talking about foundational savings, okay? You got to have foundational savings. So for those of you that don't know what foundational savings is, the first question I'm going to have for you is, do you need to save more in an emergency fund, okay? Having money in an emergency fund is crucial. And before you are saving money in your investments, you should definitely have an emergency fund set aside. So let's talk about what you should probably have aside if this is you and you need to save more. So if this is the case, this is how I think about it. This is how I'd like you to think about it. I think it's a good way to set some overall guidelines on how much you should have saved. So if you're a single person or a single filer or a sole income earner in your household, then I'd like you to consider setting aside about 6 months of living expenses in your emergency fund. So if you have just one income coming in, figure out what your base level needs are to survive. This is not all the extras, but just your base level of need. And I want you to keep about 6 months of money in an emergency fund. For those of you that have over 6 months, because there's a lot of you that I talk to that just have a lot of cash sitting to the side, you really want to pay attention, because anything more than 6 months, you have to remember there is a little evil factor out there called inflation, okay? So what inflation does is, essentially what it is the cost of goods and services rise over time. And so you want to have your money invested so that it is growing and keeping up, if not outpacing inflation. And if any of you have seen the gas pumps lately or gone to the grocery store, we can already see that there's been some increased prices that we've had over the last couple of years. And a lot of this is kind of the short-term stuff when it comes to some of the political things like, stopping oil lines and things like that. But we also just printed about $4 trillion. We're going to be printing another $2 trillion here very soon. And it might feel good to get $1,400 in your bank account. But at the end of the day, that's about $5,700 per person that we're printing that's going to go to other things besides just your bank account. Okay, so you want to make sure that your cash is earning more than inflation. And general inflation, the target is somewhere around 2%. You can use 2 to 3%. So if your money's sitting in something like a CD earning 0.5% or less these days, or even worse, a savings account that might just straight say 0% return, you want to look at how much you have saved aside. And if it's above 6 months, you might want to look at doing something with that money. And again, I'm going to give you some ideas today what to do there. Okay, if you are married and both you and your spouse are employed, okay, so we have two household incomes, both you and your spouse are employed, then you might want to consider only keeping about 3 months aside. And the reason for that is if you have 3 months aside and you have another income coming in, well, you don't really need to have quite as much cash sitting there because you're going to have 2 incomes. So essentially, you're splitting your risk up a little bit there. So if one person makes a lot more than the other, you may want to adjust your account. But the general recommendation is 6 months for sole earners and 3 months for joint earners. Okay. If you're a high income earner or an entrepreneur, then you might want to consider setting aside as much as 18 months of living expenses to take advantage of job mobility and business opportunities. So this is something you might not have heard before, this recommendation, but I think it's actually a really smart recommendation because if you're somebody that's earning, let's say $200,000 or more, or maybe let's call it $150,000 or more, you probably have a different sort of opportunity when it comes to moving around the country and taking advantage of other high income opportunities. From what I've seen, the higher income you are, the more opportunities you might have, and you might have to get pulled out of your local area and you might move around a lot to earn this high income. And on the same note, if you're an entrepreneur and you own a business, well, a lot of times when you own a business, there are opportunities. And that could be doing things like, taking on bigger projects, for example, or finding a new location and getting a deal on it. Those type of things, if you're an entrepreneur, you might want to keep a lot more cash aside. So I'm recommending here that you keep up to 18 months aside just in case you were to have ever have any sort of problems or opportunities to take advantage of. So I don't know if any of you have heard of that before, but I think that's a good idea. Okay, so if you have all of your emergency fund in place, well then a next stop here, especially if you're getting close to retirement, is to start thinking about healthcare savings. Okay, this is something that some of you thought about, but some of you haven't. And a few weeks ago, I talked about, health savings accounts, and I believe the average savings in a health savings account was around $6,000, okay? So I'm going to talk about flexible savings accounts first, but then I'll get to HSAs or the health savings accounts. But these accounts are very powerful, and you can really leverage them for a lot of good things. So let me talk about FSAs first, and then we'll get to the HSA, which is my favorite account. So if you have a flexible savings account at work, you might want to consider making a tax-deductible contribution, which for 2021 is up to $2,750, which can be used on medical, dental, vision care, any of those type of things. But you have to remember that for FSAs, okay, we're going to do a lot of lingo today, all right? So bear with me here. If FSA for flexible savings account, if you don't spend these by the end of the year or by the grace period, you're going to lose any remaining funds besides about $500. So FSAs are a good account to use for tax deferral or to use for tax-free, medical expenses you can use for you, your children, whatever it may be. But they have a downside where if you don't use the funds by the end of the year, then you lose it, okay? This is usually to lose it. Now I want to talk about my favorite health savings account, okay? Or my favorite savings account. I think a lot of people really underestimate the power of health savings accounts, also known as HSAs. HSAs are what are called triple tax advantage, okay? This is the most tax preferred vehicle, even above a Roth IRA, okay? So the reason for it is when you put money in an HSA, it is tax deductible today, okay? So you get to take money off your taxes today, up to $3,600 for single filers or $7,200 for a family, and then an additional $1,000 if you are age 55 or over. Okay, so you get a tax-deductible contribution today. Then, in most accounts, once you get above $1,000, you can actually invest this money just like you could, an IRA, for example. And so if you invest the money as well, those investments are going to grow tax-deferred inside of your HSA, just like an IRA, okay? So there's no taxes going on yet. And then when you go to take the money out, when it's for some sort of qualified medical expense, it's going to be a 100% tax-free distribution. So this is a beautiful account. And so that's why it's called triple tax advantage. The money goes in tax deferred, it goes in tax deductible, it grows tax deferred, and then it is taken out 100% tax free if used for medical, qualified medical expenses. And that's opened up quite a bit lately in the last few years. So if you have an HSA available and you're not fully funding this, I really want you to consider putting some money in here, because this is a very, very useful account. And just so you know, once you turn 65, you can use it just like an IRA, where a traditional IRA, I should say, where, if you want to just take it out to use it for your living expenses, you can pay taxes on it. But if it's for anything medical, which I think we all know as we age, we're going to have medical things that come up. So we really want to make sure that you're taking a full advantage of this account. Okay. So hopefully I'm saying that enough. If you have any questions about this, then you want to definitely reach out. And Mary asked a good question. Can anyone open an HSA? So Mary, the answer to that question is you have to have a high deductible health plan, okay? So you have to have an HSA qualified plan, and that's typically high deductible. So for a family, it's about a $1,300, $1,350, I believe, deductible. And if you have that, then you might be able to be qualified for an HSA. So I really, really want you to be looking at this account, okay? So someone else asked a question, can HSAs be used for health insurance premiums? So technically you can use them for health insurance premiums, but it doesn't mean it's not going to be a tax-free distribution for that. It's going to be a taxable distribution if you do that. You can use them for COBRA, by the way, and that can be a tax-free distribution. So another good question, are you required to use the funds in HSA each year? No. That's why I like this account a lot better than the FSA, because FSA, you have to use the funds by the end of the year. Okay, the HSA, you get to take that with you, and that's going to stay with you wherever you may go. And essentially, you don't really have to take those out. You can leave them in there all the way through retirement and just use it for healthcare. So really, really beautiful account, and great questions today, by the way. I appreciate those questions. Okay, so let's talk about retirement savings. Okay, this is our favorite one, and this is probably, most of you are familiar with this here. So the first question I'm going to have is, do you have a retirement plan offered through your employer? So I meant to say, do you have, not do you need have. Do you have a retirement plan offered through your employer? So if you do, we definitely want to start here, okay? You always want to make sure you're contributing enough to maximize the amount of any match offered by your employer, okay? That is a key. Always get the match. That is what we call free money. It's one of the few types of real free money that there is out in this world. So you always want to start there. For any sort of normal workplace retirement plans. So we're talking about 401ks, 403bs, TSPs, those type of accounts. You can contribute up to $19,500 annually, or up to $26,000 if you're age 50 or older. So if you're age 50 or older, you get what's called a catch-up contribution of an additional $6,500 you can put in per year. If you have made the maximum salary deferral contribution, so if you've contributed up to $19,500 or $26,000 if you're over 50, and you want to contribute more, there's a term called mega backdoor Roth contribution. Okay, so this is beyond the scope of what I'm going to talk about today. But I want you to go out and Google this, and I can do another workshop on it. But essentially, what it is if you have the ability to put in after-tax contributions into your workplace retirement plan, what you can do when you go to leave your employer, I think you can do it along the way in many plans as well, is you can actually roll that after-tax money into a Roth IRA account, and that's a beautiful way to get a lot of money inside of a Roth IRA. So that's a whole separate subject. I'm not going to go into that today. All right. So now the next question, once we're looking at our workplace retirement plans and we're moving on, we're going to go here. Do you expect income to increase in the future? So if you expect your income in the future, let's say after retirement, to be in a higher tax bracket than you're in today, when you might want to consider contributing to a Roth 401k instead of to traditional 401k. So by contributing to a Roth 401k, you're going to pay taxes now at the lower rates. And then in retirement, you'll be able to take that out tax-free in the future. So Roth 401ks can be very useful. There's another vehicle, if you don't have a Roth 401k available, it's called a Roth IRA. And with the Roth IRA, you can contribute up to $6,000 per year per spouse, okay, per spouse. So if there's only one person working, you each can put in $6,000, and the spouse that's not working will just have to open what's called a spousal IRA or spousal Roth IRA, and they can contribute an additional $6,000. And the limit is $7,000 if you are age 50 or over. So you get an extra $1,000 of room there. There is a caveat here with the Roth IRA that the eligibility to put money directly into a Roth IRA is going to be phased out between $125,000 and $140,000 of income, MAGI, modified adjusted gross income, if you're single, and $198,000 to $208,000 MAGI if you are a married filing joint taxpayer. So if you have a Roth 401k, there's no income limits. So this is a beautiful way to get some money into a Roth account if you're high income. But you really want to look at the difference between putting money in now and paying tax today, or paying taxes later after retirement, because many folks are in a much lower tax bracket in retirement. And so it makes more sense to put money pre-tax today, but you can also do a split. You could put a split. You can, if you're saving, let's say, 15%, you can put 7.5 in a pre-tax account and 7.5 in the Roth account. That's a good way to do it too. But really thinking about where your future taxes are going to be is going to help you make a decision today. Okay, so if your MAGI, your modified adjusted gross income, is greater than $140,000 if you're a single filer, or $208,000 if you're a married filing joint filer, and you have maxed out your 401k contributions and you want to save more, well, then let's consider the following. There is a technique called a backdoor Roth IRA contribution that can allow you to save an extra $6,000 per year into a Roth IRA, or $7,000 at 50 or older. But the key is you don't go directly to a Roth IRA. The way to do this is you put money in a non-deductible pre-tax traditional IRA, and then you have to wait a certain amount of time, and then you can convert that over to a Roth IRA. Okay? You really want to make sure, if you're going to do this, you don't have any earnings in your non-deductible IRA before you convert. Because if you have earnings, then you're going to have a mess on your hands, and you're going to have to keep track of that, and that's just not a lot of fun. So, but this is a way to get money into a Roth IRA account if you're a high income earner and you want to save more in a tax deferred vehicle. You really want to look into this. I think it's a great strategy. Okay. And as I mentioned before, if your employer's plan allows after-tax contributions, you may be able to make what's called a mega backdoor Roth IRA contribution. So what this is you can contribute, your normal $19,500 or $26,000 directly to your 401k account. And then if you have an after-tax contribution, and if you add up all the numbers between your contributions and your employer's contributions, you're going to have an ability to save up to a total, when you add up all three, of about $58,000, I think it is this year. I don't have that in front of me here. And about $62,000 if you are age 50 or older. Don't quote me on those numbers. Let me look those up real quick. The total amounts are a little higher than, I think it's $58,000 for a, I don't have that sitting in front of me here. Don't quote me on that, but it's up to about $58,000, $60,000, somewhere in that range. Don't have those sitting in front of me, but I can get back to you guys on those. I'll put those later in the comments. But if you can save more above the $26,000 if you're over 50, or above the $19,500 if you're below 50, and your employer's plan allows for after-tax contributions, you can put money in the after-tax, and then when you leave, or really throughout the years, you can roll that money over into a Roth IRA and really build up a huge Roth IRA account. That's why it's called a mega backdoor Roth IRA. Okay, so next question. Does your employer offer an employee stock purchase plan, or ESPP? Okay, so employee stock purchase plan is a company-run program. So essentially what it allows you to do is purchase company stock at a discount. Most of the time it's around 15%. And employees can contribute to the plan through payroll deductions generally. And then those build up between the offering date and the purchase date. So the key with this is, you really want to review your selling strategy in advance. Some folks will just sit on a bunch of company stock and just let it sit there and grow. And that could be an okay idea, but you also may end up with too much money that's very concentrated. Okay. So, Enron is like the best and the worst example, because Enron was an extreme example. But if you look at what happened back in, I think it was the 80s or 90s with Enron, where people had all their 401ks were full of company stock, and then the company went to zero and they lost all their 401ks. That's an extreme example, but it's a similar type of thing, where you really want to think about having proper diversification. So let's say you get that 15% discount. Well, and then let's say you're going to sell after 1 year, and then you're going to take your 15% gain and whatever else the company stock made, and now you're going to go put that into a Roth IRA, but hopefully you made at least 15% on that. Hey, that could be a reasonable strategy, but you want to make sure you're doing what's best for you in your particular situation. Okay. All right. Next section here is, are you or your dependents planning on attending college? Okay. So if you have people in your family, children, grandchildren, that are looking to attend college, you might want to consider contributing to what's called a 529 plan. Okay. For a 529 plan, you don't get a tax deduction for putting money in, generally, not federal at least, but you do when you put money in. The money's going to get to grow tax deferred, and all those earnings will be tax free if you take them out later and use them for college. So you can use your annual gift exclusion amount up to about $15,000 per year to put in your beneficiary's 529 account gift tax free. So this can be a great way to save for college. There's also another technique called super funding 529. So you can use this technique called super funding a 529 to fund your account with up to 5 years of contributions all at one time. You can do this in 1 year with no gift tax. So it's up to $75,000 and treat it as if it were made evenly over a 5-year period. So why would you want to do this? The real reason to do this is compound interest. Okay, so think about it like this. If you're putting $75,000 in 1 year and that account gets to grow for 5 years, and you can't put anything else in for the next 5 years, by the way, but that gets to grow for 5 years, what's that going to turn into versus putting $15,000 a year per year for 5 years? Most likely, you're going to come out ahead by putting a big contribution in 1 year. And so that is called super funding. So this is for those of you that have a lot of money sitting around that you want to contribute to college, okay? Or you have kids that want to go, or grandkids that want to go to these big, fancy, expensive schools. The other thing to consider with a 529 deduction is that 529 contribution is that you may be eligible for a state income tax deduction or credit if you contribute to a plan sponsored by your state, okay? So many states have the ability to do this and many don't. Where I'm at in California, we don't get a deduction for this. So what I look at is what state has the best plan. And so there's some good plans out there that are better than California. So I look at a few other states when I'm recommending which state to use for a 529. But you want to compare your plan options to other states. But if you're going to get a deduction of some sort, then you probably just want to use your state plan so that you can maximize that. Okay. For children or grandchildren that are minors, you can use what are called UTMA or UGMA accounts to save, but you really want to be looking and be mindful of kiddie tax rules. There could be some things involved there, but these are okay. I mean, these are an okay place to put money if the kids are minors, that you can do some things with it and they have their own special rules there. All right. And we are going to talk about tax-deferred insurance options, okay? So for those of you that know me, you know I'm not a huge fan of insurance and annuity products. I think you're better off in just having things in investments. But you can actually use something like an annuity to put more money in, or a cash value life insurance policy, which can provide tax deferral on the gains. So these types of products are useful if you've maxed out everything else, okay? You really want to make sure you're maxing out everything else. The problem I see with them is that many people are sold these products being said that, oh, these are like the Roth IRA for rich people. And it's like, well, okay, yeah, like people use these. If you have $1 million of income and you're maxing out all your other retirement accounts, sure, rich people might use these, but these are not a great place to start, for your overall savings plan. You want to max out the other vehicles first, and then you can use these. So I put my disclaimer in there. Please make sure you understand these products you're using, as there are many varieties and potential fees involved. And that's usually the problem with these, is there's big fees involved in them a lot of times, not always, but a lot of times. So I see people just getting, paying 4, 5, 6 times as much as they should. And there are some good products out there, by the way. There are some good products if you want to use insurance or annuity products, but I recommend you work with a fee-only advisor so that you can get the best options out there, okay? And then other options here are the taxable brokerage accounts, okay? So looking at taxable brokerage account, most of these you're probably pretty familiar with these. It's just a basic brokerage account at any sort of the custodians you want to use. The thing you have to consider here is that long-term capital gains are taxed at preferential rates upon the sale, okay? So there's no tax at distribution from the account sometimes, but if you are going to be selling, you might have a capital gain tax of some sort. And then if you have dividend stocks, for example, qualified dividends are also tax at preferential rates. So the good and the bad about these type of accounts is like if you own a bunch of dividend stocks, people like those sometimes because they feel like they're earning income for their retirement and it's like a steady income. But in reality, you lose control because you're just going to get those dividends distributed. And so it's not like it's in a tax preferred account like an IRA where you can take the money out when you need it. This is just going to get kicked out. And so I've seen many people go to the next bracket on, getting taxed for Social Security or getting taxed or going to the next tax bracket because they had a big dividend distribution and they thought they were doing the right thing, but now we lost control, of when we're claiming this income. So, dividend stocks are okay, or dividend funds, but you have to remember at the end of the day, you're selling off your stock. So you could just have typical non-dividend paying stocks and then not, only sell when you want to. So again, these are some things to think about. And then bullet point number 2 there is that there are certain investments that can help you manage any tax liability. So looking at tax managed funds, zero dividend stock funds, municipal bonds, and then ETFs. ETFs can be very tax efficient. They can help you mitigate tax liability. Okay, so a lot here. So what I want to do, one more thing, I'm sorry. If you are charitably inclined. So if you're charitably inclined, you could consider a donor advised fund with increased standard deduction with the Tax Cut and Jobs Act we had a few years ago, back in 2017. Most people are now just using the standard deduction. I think it's in the neighborhood of 90% are getting a standard deduction. So if you are charitably inclined, you might want to consider bunching your donations and doing a big chunk in 1 year and then putting it in a donor advised fund. And then you get that tax deduction in that year, and then you can distribute as you see fit over the next, whatever number of years. So that way you can actually get a tax deduction for that. So something to consider. And then one last thing, I have to put this in here, but of course, if you have any high interest debts, then you really should consider paying those off before you're saving more. If you have a credit card at 14%, well, it doesn't make sense to save money trying to earn, in the market 10, 12% because you're going to lose. But these are things I just wanted to mention to make sure we're on the same page here. Okay. All right. So let's switch gears here and let's talk about putting this all together. Okay. I created the visual, and part of the reason why it took me so long today because I had to do this animation thing, and hopefully you enjoyed and appreciate it because it took me forever. But I love you guys. I want to make sure that we are, I'm really doing my best to give you some great information. So let's see if this comes up here and if it gets shared the way I want it to be shared. Okay, good. It looks like we're looking good here. Okay, so what I want to talk about here is a savings contribution workflow, okay? And if you are on my email list, I will send this out as a PDF this week through email. If you're not on my email list, go to keepitsimplefinancial.com and go ahead and download the one of the downloads there. Just join anything there basically, and you can get on the email list. But I will send out this workflow this week. So I put a lot of time into this, and again, I have to just say that everybody's situation is going to be a little bit different. So I want to make sure that, oops, I need to switch my screen here. We're on the wrong screen. I want to make sure that you do things that are proper according to you and your needs, and make sure that we're making good decisions here, okay? Because not everybody's situation is going to be exactly the same. So hopefully this lines up the way I want it to now. So the first question is, do you have your emergency fund, okay? If you don't have your emergency fund in order, that's number one, okay? So we definitely want to get our emergency fund in order. So like we talked about initially, we want to make sure you're save up somewhere between 3 to 6 months expenses. So if you don't have that in place, you should not be doing anything else. You should just be focusing on that before you go to your investments, okay? Once we get our emergency fund in place, now we can start talking about where to put some extra money, okay? So the first place most people are going to go are going to be to their workplace plan. So that's normally their 403B or 401k, TSP for my military folks, my government folks, up to the match. Okay, so in that account, as you can see in the blue box there, and there's a little key down below, all the blue boxes are going to be the annual contribution limits for 2021. So you can put up to $19,500 or $26,000 if you're 50 or over. But I always want you to start with the match. And then once you get the match, you want to start going to some other places potentially before you go back to this, okay? So the first place I would go, if you have this available to you, is to an HSA. because the HSA is such a powerful vehicle. It's just, you can use it just like a normal account. You can invest in it, and it's going to be a tax-free distribution. And it's just a beautiful thing, especially for your high income folks. And I, with the average balance in HSAs being about $6,000, I'm pretty sure you can fund this and still be in a good place. Most people really need to fund these more. Okay. So the next place to look, I would be looking, is in a Roth IRA. Roth IRAs are beautiful. You put money in after tax, and then it grows forever tax-free. There's no requirement of distributions on that account. So at 72, you don't have to worry about taking money out like you do your 401k. But depending on which type of accounts you have, these are a little bit interchangeable, and how much you can save. Okay, so if you can save a lot of money, then you might want to choose one over the other. But I would really recommend you consider looking at your HSA and your Roth IRA after you get the match in your 401k, and your tax bracket is going to help you decide that. And then from here, we want to mention FSA. So if you have a flex savings account, that's okay. You can put some money in there up to $2,750. That might be a good place. But again, remember, this is a use it or lose it account. So if you don't spend that money on some sort of healthcare, you're going to lose it. Where the HSA, the reason I like that account so much is because you can keep that and you can transfer that over job to job. That stays with you forever, and you don't have to take money out of it till way later until you need some healthcare down the road. So it's a really nice account. Once these accounts are considered, then I would recommend you consider going back up to the limit in your 401k or your 403b, whatever type of account that you have. And then that's when you can hit that $19,500 or $26,000, depending where you're at. And same thing here for the Roth IRA. So some of you will have HSAs available to you, some of you won't. Some of you will be able to contribute to Roth IRAs, some of you won't. But once those accounts are funded, then you can consider going back and hitting the savings limits on the 401k, 403b workplace retirement account. From here, now we have a couple different options, and this will get a little bit more specific depending on your case, but this is just what we talked about. And essentially here I'm laying out visually everything I went through just a minute ago. So option is 529. You can put up to $15,000 per year in the 529. That could be a good place to put some money. Your employee stock purchase plan could be another good place to put some money. Taxable brokerage could be another good place to put some money. And annuities or cash value life insurance can be a good place to put some money. So these are all areas, all different types of accounts that you could consider when you are deciding where to put your extra savings. So I like this visual because it really helps me see everything in one place and gives me a workflow. So if you like it, so I'm going to put it in this week's email that gets sent out, which we usually send that out on Wednesday or Thursday. So make sure you get on our email list for that. Okay. But hopefully this is helpful. I'm going to hop over now and take some questions here. And so let's look at these questions we got for you. Okay. Let's see what questions we have. So if you have questions, please put those in the comments now, and then I will do my best to answer those. Okay. So let's go through here and see what we got. Some of these I already answered. So good question here. So you are not required to use the funds in HSA each year. No, you're not required to use the funds in HSA each year. That's why I really like this account, because you can just leave it in there. And what you can also do is you can, instead of paying for your healthcare out of your HSA, if you have healthcare costs, you can actually just save your receipts. And then if you can invest the money inside your HSA, you can invest the money for the next 5, 10, 15, whatever number of years. And then at any point, pull out all those receipts and then repay yourself from the earnings, not your contributions, 100% tax-free. So that's a beautiful thing you can do. Good question. Let's see here. So what about SEP account? So a SEP account is it's a SEP IRA, self-employed pension IRA. That's a beautiful account for self-employed people. I was going to go into business accounts, but I'll probably do that in another one because it was just going to be too long today. So, but yeah, that could be a great account, just like an IRA. Do you need earned income to contribute to a Roth IRA? Yes, you do need earned income to contribute to a Roth IRA. That is a requirement. Okay, so in another video, talk about rollover to Roth, backdoor Roth. Okay, yeah, we can do that. Definitely can do that. So did I miss where retiree can put money, max out IRA for spouse and self? So Mary, in that case, we want to go back here, not this one here, to our workflow here. And if you are already maxed out your Roth IRA, then I would ask you, okay, would you have an HSA you can contribute to? Because you don't need income to contribute to an HSA. And then if not, then you might want to look at either a 529 plan if you're trying to contribute for children or grandchildren, a taxable brokerage. If you are retired, anybody can contribute to that. And as a last resort, your annuities or cash value life insurance. Most likely, your taxable brokerage is going to be a better spot, but that's something you might want to consider. Good question, though. Let's see here. Okay, so if no match on 401k, would I contribute? Oh, let me see. There's actually another question here. They say finish the question. Okay, so if no match on IRA, would you recommend going right to Roth IRA? So this is where it gets a little more challenging. This is where I'd say look at your tax bracket. But let's say, for example, you're a married household and you're making less than $80,000. Well, that puts you in a 12% bracket. That's a pretty good chance you might want to go to a Roth IRA. But if you're working today and let's say you're in a 24% bracket because you make over $200,000, well, then you might still want to take the tax deduction today because more than likely you can do what's called a partial Roth conversion and then roll that money to an IRA a little bit at a time after retirement. So it's a little bit more tricky there. It's going to depend on your tax bracket. But if you're not getting a match, and you might want to move down the workflow there. Okay. How can a person get an HSA? So to get to an HSA, you have to have a high deductible health plan that's HSA qualified. So if you're buying insurance on the marketplace, you can get that. Or if you are going to buy it through work, then you want to look at the options. And you're probably going to pay less monthly for an HSA qualified health plan because it'll have a higher deductible, but you'll have a bigger deductible. But the way you want to look at it is what's your break-even point? Back in many years ago, when I worked for a corporate job, my HSA there, it had a $2,400. It had a $1,000 deductible, but it saved me $200 per month on insurance. So the way I looked at it is, well, if I'm saving $200 per month, well, after 5 months, I'm ahead, right? Because I'll have my $1,000 deductible saved as long as I put it in the HSA. So after that 5 months, it's money in the bank for me. So you really want to look at your plan and then see if that's offered or where that's offered. But it would either be through your workplace or through the exchange if you're buying through the exchange. Okay, we've got one more question here. We're going to wrap up for today. So is a 401k limit $26,000 for over 50 when it's pre-tax or Roth? The answer is yes. So it's for either. Okay. So the benefit of putting it in Roth is if you're putting in $26,000 after tax, well, you're effectively putting in more money, right? Because if you're putting it in pre-tax, well, at some point later, you're going to have to take the money out and you're going to have to pay for that. You have to pay the taxes on that money. So that is a tax bracket question. To like we said, are you going to be in a lower tax bracket now or a lower tax bracket later? But the limit is $26,000 regardless. And the second question here is, can you have a Roth 401k and a Roth IRA? The answer is yes. You can actually have both. So you can double those up if your income is within limits. So for someone like me who's a business owner, we have what's called a qualified business income deduction, where for any income that I claim for my business, I automatically get 20% off the top until I make somewhere in the neighborhood of $300,000 or $400,000, which I don't yet. So it actually makes more sense for me to put money to a Roth account and not to take the deduction. So I'm basically doing what you're talking about here. I think that's the best way to go for me personally. But I think everybody has a unique situation. But if you want to just have a tax-free future and you think taxes are going up and taxes are on sale today, well, then you might want to take advantage and just do a Roth 401k and a Roth IRA. But really good question. Okay, I think that's it, folks, for questions. I'm going to throw up my website here. If you want some help, you want some help mapping this all out, you want some help with your retirement planning, I would love to help you. We are bringing on a new certified financial planner this week. So we're going to have some more help, which will be great. But you can go to keepitsimplefinancial.com/talk. And we offer complimentary consultations to help you really get clear on what you're facing going into retirement. And if it looks like those are things that you could use our help with, then we definitely will let you know that. But there's no cost, there's no pressure. We don't do high pressure sales or anything like that. But what our goal is to help you get clarity on what you may be aware of for your retirement and what you may not be aware of for your retirement. And if there's things that you need assistance with that you may not be aware of, then we're happy to help. Okay, so no cost at all for that, and we'd be happy to chat with you. I'll put the link as well down below. So you have a wonderful afternoon. I appreciate you so much watching. Thank you so much for watching. This one just took me a little bit longer today. I usually try to get them done about 2 o'clock in the afternoon Pacific time on Sundays. Just that little workflow we went through just took me forever to get it animated. So thank you for tuning in later than usual. But I appreciate you. Have a wonderful afternoon, and we'll see you next time, okay? All right, bye-bye now.